how do you avoid the drama associated with earnings? Well, let me show you what your choices are. Okay, how to avoid the drama of earnings. Well, number one, trade ETFs during earnings season, right? ETFs don't have earnings. S&P is not going to gap up or down 10% overnight. So trade an ETF, right? Number two, you can trade stocks, but just don't hold any stock into earnings. Just get out beforehand. So Amazon, if I had to trade on Amazon and I wanted to avoid the earnings drama, I would have closed it before the bell today. Same thing with Microsoft, same thing with Intel. Just close it the day of. And really, all you have to do is not hold it overnight, right? It's not 4 months out of the year that you can't trade it. It's 4 days out of the year, really 4 nights out of the year that you don't want to own it, where that earnings risk crops up, right? And so it's not like it's making it that challenging to trade, right? So don't hold any stock into earnings. The issue with long-term investments is if you own a stock more than 3 months, you have to hold into earnings. And so if you do hold a stock into earnings, how do you do that with intelligence? How do you do it and not risk the farm, so to speak? Well, number one, we could say you better be comfortable with holy Toledo, the fundamentals of the company and the typical size of its gaps, right? So is there anything wrong with me, I don't know, trading Intel and saying, well, Intel tends to gap, 5% on earnings, 10% at worst. If this thing drops down 10% tomorrow, given the amount of money I have in here, I'm okay with that. And I like the fundamentals long-term on Intel. I think longer term it's going higher, so I think it'll be a short-term hiccup anyways. Okay, that's fine. Then hold in earnings. That's okay. But that's the prereq, okay? If it gaps down 10% and you come whining to me, I'm going to say, well, what did you expect? Right? That's the nature of a binary event where you get a ton of volatility, right? So that's number one. Number two, if you're going to hold into earnings and you don't really like this idea of just being a lottery winner the next day if it turns into Chipotle and goes up 25%, or it turning into FCX and dropping 15%. Like if you don't like those extreme, outcomes over the next day, then do something about it, right? So you could use options to reduce your risk. Okay, you could use options to reduce your risk. And so what you could do is maybe you sell covered calls, right? This offers a modicum of protection. We're going to expand your vocabulary, okay? It offers a little bit of protection, a modicum of protection. Not comprehensive protection, but a little bit of protection, okay? For example, take a look at Microsoft, okay? Microsoft closed at $94.26. Okay, $94.26. Let's say I owned 100 shares. I'm going to click on the ask price of the stock here. It brings up in order to buy 100 shares. I need to change that to what the closing price was. Boom, boom. And hit analyze trade. And it's going to show me the risk graph. So this is long stock going into earnings, where this is long stock at any time. Right? Stock goes up, you make a bunch of money. Stock goes down, you lose a bunch of money. Okay? Well, if you're not comfortable with this wide range of potential outcomes into an uncertain event, well, there's some things you can do about it. So if I wanted to reduce risk heading into Microsoft earnings, maybe I would have come in with the stock at 94 and sold a 30 delta call for June. Maybe I would have sold a 100 strike call for June and brought in about $1.30. Okay, what happens if I do that and bring in $1.33? Well, I would get $1.33 of protection. Let's write this out. Let's write this out. So this is the Microsoft, the Mr. Softy example. Okay, MSFT. I own 100 shares. Okay, because I like Bill Gates. That's why I own 100 shares of MSFT at $94.26, and I want to sell a June 100 covered call. I'm going to get paid for that. When you sell calls, you get paid. I'm going to get paid $1.33. Okay, so think of the perks. The perks. Perk number one is, well, I have $1.33 of protection, right? My cost basis or break even falls from $94.26 to, put your thinking caps on, guys. What is $94.26 minus $1.33? I know $94.26 minus $1 is $93.26. I need to take 33 cents off of $93.26. I know that if I took 26 cents off of $93.26, it would be 93. Now I have what? 7 more cents to drop. So $93 minus 7 cents is $92.93. So I just dropped my break even to $92.93. Whew. If I look at the risk graph, here's the before. My break even, boom, $94.26. That's where I break even. When I add the covered call, boom. Look at that red line. It shifted. The red little hash mark. Now my break even is $92.93.